And good morning to our wonderful audience. Welcome back to Boutiques on Wednesdays on this chilly morning in Gauteng. I'm not sure about the rest of the country. If it talks about snow, we're not going to talk about the box this morning. We're going to look at asset allocation in a flexible mandate. And it's my absolute pleasure to welcome the team from Granate Asset Management this morning, here to share exactly that, their views on local and global asset classes and how that all comes together in the Granate BCI Flexible Fund. Joining us online now is Henno Vermaak and Catherine Blanche. Catherine and Henno, good morning. How are you this morning?
Good morning, Eugene, and good morning to the audience. Thank you very much for this opportunity. We are well, and we are very happy to talk about the Springboks as well, if you're interested.
Magnificent, most definitely, and a lot better than our markets, I would think. Although the Rand did recover ever so slightly, I wonder if that's got anything to do with the Rand here over the weekend. But we'll talk about all these things and a bit more. Henno and Catherine, maybe if I can start off. The fund is a true multi-asset fund, and like I mentioned in the introduction, covering just about all asset classes, local and global. And that implies that you need a very strong team with pretty much capabilities to cover all asset classes. By way of introduction, can you maybe give us some insight to what your team looks like and the capabilities within the Granate team?
Sure. I'm just sharing our slides here.
Yep.
Do you see the slides there?
Yes, it's fine. Perfect.
So why we come to work every day at Granate is to protect and grow the savings that our clients entrust to us. And Granate is ultimately a people business. It's the people that make that happen. And it really requires two things. The first is bringing together a team of people that are committed to what they do, passionate about what they do, and come from very diverse backgrounds, have very diverse skill sets, and ultimately really care about the outcomes for our end clients. And then the second part is creating an environment where those people can thrive. And that means really loving coming to work every day, enjoying working with each other, even when we really disagree. And to do that, it really means that we've had to spend a lot of time, and we're going to keep doing that, working on our culture to make this a place where people really love to come to work every day. I've been here for 4 years, and I can genuinely say that I enjoy coming to work every day, except for maybe today, because I was very nervous about doing this presentation because it's my very first one here at Granate.
Doing well so far.
So if I can just show you our team. We're 19 people now at Granate, and first I should say that everybody here is equally important, not just the 10 faces you see on the screen who are our investment team. But within the investment team, we're 10 people at the moment, and that really does cover, as you said, all the different asset classes, and that ranges from people that have worked in the fixed income space for many years together that you see on the left-hand side of the screen, and ranges from those to people that have been added on along the way, adding quantitative experience, adding deep credit knowledge, to people that have worked more in the equity space and have a long history of managing multi-asset and equity type funds together for a very long time. But the important thing about this, when you look at this picture, is that we have one investment team with one investment process. So we all sit in the room together in our investment committee. We don't carve out different portions of the funds that are managed by different people. And the reason for doing that is that we think that to be good managers of our clients' money as individuals and as a team, we need to be good investors. And to be a good investor, you really need to understand, at least on some level, all asset classes, so that you can be aware of the opportunity cost of choosing one over the other.
But makes a lot of sense. And I mean, in that slide you showed, very notable, and I'm trying to understand that I do not see a chief investment officer. How does that work?
Yeah, that's a smart thing to pick up. We think that we've put in a lot of effort to build this team, and this is a a diverse team with people with different backgrounds, different academic experience. I mean, we've got, just going through the list, we've got engineers, a few MBAs, a few CAs, CFAs, we've even got a few musicians, a journalist, and people that might have made a successful career out of dancing or endurance athletics either. So the last thing we want to do is to reduce the value of that diverse thinking that we can have within the team. And we've seen one of the risks ultimately of having a strong voice around the table, which might be the CIO, is that it tends to dominate the conversation and might reduce the willingness of individuals to pick up. Is there echo here somewhere?
No, it's all good, Hidden. On our side, it's fine.
So for us not having a CIO means that we can encourage everyone to become part of the conversation. As Catherine said, it's a one-team approach, and the whole team is involved in the management of the funds. And it is important that everyone has got the willingness and ability to speak up if and when they see an idea or they identify a risk. We don't want anyone's voice being suppressed at all. And for that reason, we in our investment committee move the chairmanship around. We have roles that rotate on a regular basis, and we force this situation of everyone thinking for themselves and speaking up when they find good ideas.
Who is ultimately accountable then? Is it the entire team?
Ultimately, yes. No, we're quite proud of the fact that all employees of the business are shareholders in the business. And we control this business. So we are ultimately, every one of us, responsible to ensure that clients have good experience from our funds. That's the only way that we'll make a profit out of this business.
And most of us, if not all of us, are invested in our funds alongside our clients. I can say for myself, literally my entire life savings is in the Granate balanced or flexible fund. So I really do feel the ups and downs and emotions that our clients would be feeling when things go well or don't go well. And we think that's also a very important part of alignment.
With your clients, that's always a good thing about any asset management company. If you do great asset management companies, like I mentioned in the introduction, we're mainly going to speak about your flexible mandate because that's where a lot of these ideas comes together. So we can unpack that a bit more. You also have a balanced mandate, a normal Reg 28 fund. But notably, I mean, you do invest in SA equity, you invest in global equity. Why do you not have an SA equity or general equity fund, nor a global equity fund?
Yeah, I think the important thinking behind all of this is that we follow an absolute return target in these funds. The flexible fund has got inflation plus 6% as its target, and the balanced fund inflation plus 5%. Now, if you have that as your target, rather than trying to trying to outperform the peer group or the market or the index, then it makes sense to be as flexible as possible in this flexible fund. We have got the experience across different asset classes, so why not use it? We think it wouldn't be sensible to limit ourselves to any geography or sector or index or anything of the sorts. We think that we can deliver a return similar to equities in the long run, but there are times in the market where other asset classes offer better opportunities than just being fully invested in the JSE. And for that reason, our flexible and balanced fund, or that's the reason why we chose a flexible fund. We thought that's the best product for our own money and that of our friends and family when we launched the fund. On the global basis, at this stage, we don't have a global fund yet. It is something that's in the pipeline. In the long run, we definitely want to have a global fund, but that too will be a global flexible fund to ensure that we can use as many of the tools available to us as possible.
We're going to speak a lot more in terms of that skill set, and if that really makes sense, because in the flexible mandate, it makes sense on paper the way you explained it, but the proof is always in the pudding. But we're going to come to that. Let's just talk about the benchmark. You did mention the benchmark of the flexible fund, inflation plus 6%. I mean, SA investors had a really tough time over the past 5 years, almost 6 years. And a lot of funds I've seen with benchmarks, inflation plus 5, inflation plus 6. It just seems that it's a really, really tall order to try and hit that real return benchmark, especially plus 6. Do you think in the current environment where we are, especially with very high inflation rates at the moment, yes, it is coming down, but do you think it's realistic and still achievable over time,
We would say yes. Obviously, we can't guarantee anything in these funds, but over the very long time, over the very long term, the returns from equities on a global basis has tended to converge around inflation plus 6% in local currency. And even also, if you measure all those individual countries on a US dollar basis, the long-term return tends to be around inflation plus 6%. So for any investor with a long-term focus, inflation plus 6% is the type of return you should be looking for. So do we think it's possible to deliver that from here? We definitely do. And it is because we see that kind of opportunity set in a number of markets and asset classes at the moment. If we just take the SA government bonds, for example, starting there, you've got a high certainty return close to inflation plus 6, and on certain days, quite a bit higher than that. So buying that and locking it in ensures that you'll get that on maturity of the bond. We think across the South African or the SA Inc. landscape, there are certain companies that we're very excited about. On a global basis, we see opportunity across the board. And even from property at this stage, we think you can get that kind of return if you're patient. So for the fund as a whole, being able to move around and allocate capital to these different asset classes, yeah, we're quite confident. Can't guarantee it, but we're confident in the long term.
Yeah, times might be tough, but it's actually a fun time to be an analyst because there are lots of opportunities out there.
Really great that you mentioned that, Catherine. I'm going to come back to that opportunity set. I want to continue with the conversation on exactly this, and you say over the longer term. But how do you think about, or do you think about, things like capital protection in the medium to short term?
I think in the short term, we know that funny things can and do happen in the markets.
Yes.
So if your fund, like we do, invest in the equity markets, then short-term volatility is part of the product, unfortunately. It's not something that you can exclude or eliminate completely. But perhaps if we talk through our investment process, maybe it might be a way of understanding how we try to limit that in the medium and long term.
I think that's maybe a good idea to have a look at that, to better understand exactly how this comes together. Yeah.
Yeah, so I thought a good way to explain this was...
Let me just share that.
Heno, who's sitting next to me, is very much a wine expert, and I am most certainly not. And because of that, I've made a mistake a few times of buying wine online, where I found something that looked like a really great deal because it was quite cheap, and it was a wine farm I'd heard of, and usually an older vintage, and you could buy a whole case of it at a bargain price. And when I tasted the first bottle, I realized that they probably had a lot of it to sell because this was actually a really crap vintage. And secondly, that it's probably sitting in the back of Cyberseller's warehouse for many months, not stored very well. And so it's not actually great anymore. And now I'm stuck trying to figure out what things I can cook with red wine in them. And especially as a vegetarian, that's a bit of a problem. I can't make beef bourguignon. So our investment process is very much designed to avoid those kind of mistakes. And we do that by separating the discussion around quality from the discussion around price. So we first look at whether a company can stand the test of time, whether it's well run, whether it's structured in a resilient way and whether it has some sort of source of competitive advantage. And we have 4 very distinct qualitative hurdles that we look at first. We have a very robust discussion and debates in our investment committee talking about only that. And once we've decided that this is actually a quality product, we then, in a separate discussion, go and look at what is this thing worth. And like I said, from my wine example, I think that shows very well that starting from the point of price to decide whether something is something you want to buy or not is a very bad starting point. And that's really why we do it in this order. When it comes down then to looking at price, obviously nobody wants to pay more for something than it's worth. And in that sense, everybody is actually a value investor. It's nonsensical to pay more for something than it's worth. But we think that doing it like this eliminates 2 mistakes. The one is that it means that you don't buy things just because they're cheap and then they turn out to be a bad investment. And that's what we call a value trap. And it's a very common mistake to say, no, it's in the price, or no, but it's so cheap, it must be a good idea. But usually that means there's actually something wrong with it. So we want to try and eliminate those companies or those investments from our universe. And the second mistake is that it's easy to say something looks optically expensive. And so we're not even going to bother to look at that because it's expensive. But if you start from the point of quality, you can really understand, is this actually an amazing bottle of wine that's well worth this premium price tag? Because it's a business that can keep going for a very long time because it's got some features around it that are truly amazing, or its opportunity set is really amazing. And so that's really the fundamentals of how we select assets or select stocks to include within our portfolio. And then maybe Henno can talk a bit about how that then feeds into our asset allocation.
Yeah, so the main considerations, firstly, that we look at in these companies is whether the governance structure is sufficient to protect us as minority investors, whether the balance sheet is strong enough, whether we can trust the management and appreciate their track record over time. And then lastly, that there is cash flow sustainability or a moat or a belief that the business can continue to do what is done in the past. Those 4 exclusionary hurdles basically is a way to protect medium to long-term volatility. Because we know that a lot of companies fail, they tend to fail for one of these 4 reasons. Ultimately, they do fail for balance sheet, but normally you can pick up the leading indicators at one of the other 3 exclusionary hurdles in time. Then, as Catherine said, if you pay the right price, you'll have a good investment outcome in the long run. So answering the question on how we might prevent volatility, short term we can't, medium to long term, we can try to do that by ensuring that we stay away from the businesses that are problems in the medium to long term, and then ideally invest and hold on to those businesses that have got positive growth potential in the long run, without overpaying for them initially when we make the allocation.
Makes a lot of sense. Henno, if we can maybe talk a little bit about your idea generation, when it comes to selecting counters and building up your portfolio. If you can maybe unpack that a bit more. And then I would also like to understand, in the current environment, if you look at the macro picture, less liquidity in the market, perhaps for longer, we understand now rates may stay long or high for longer. Does that impact on your idea generation or what you look at?
Yes, it does. But I would start by saying that macro is not something that we try to predict, and hence we will. It's very unlikely. It's not impossible. It's unlikely that we'll take any position based purely on a macro basis. There's obviously the top-down approach and the bottom-down approach. We are closer to the bottom-up approach in allocating or constructing our portfolios. It means that individual counters that we own need to deserve to be in the portfolio on a standalone basis. But if I perhaps show you this slide, it might assist in some of the discussion. This is
got the slide, yeah.
this is our fully integrated process that we follow, and you rightly identified security selection. There we've got a number of tools at our disposal to try to find interesting areas to invest in or to analyze and research. But we also throw the net quite wide. We're not limited to any valuation screens or anything of that kind. Sometimes a good idea is something you see in a movie, or you read in a book, or in a magazine article, that there's some reason to think that there's a long-term growth potential in an industry or a market or a sector or anything of that kind. What we'll do then is to try to figure out which companies around that area looks attractive. But then after the security selection, we will consider diversification and concentration risks. It's all good and well if you think that semiconductors might be a good investment opportunity, but even the semiconductors go through cycles. So do you really want to have 100% of your portfolio invested in that? Probably not. Then thirdly, we'll constantly look at the relative and absolute valuations of the individual positions we have in the portfolio. Those move obviously at different times and come into and go out of favor, and we might change our allocation based on that. But we also try to understand all the relevant cycles. And that's perhaps where some of the macro thinking actually enters the frame. We want to understand whether, if we use inflation or interest rates as an example, it's difficult to predict exactly what the basis point change in any rate of inflation or interest rates might be over time. But you can kind of try to identify where you are in a cycle, whether you're at a high or a low point or somewhere at a fair value range, and position yourself accordingly, or at least identify some of the risks that might be leading on from the position in the cycles. And that could be, in commodities, it's more direct. If you're looking at gold miners, you need to have a view on the gold price. But if you're looking at financial companies, then the interest rate cycle is important, and it's not simple. It could be complex. Some companies benefit from high short-term rates. Highly geared companies obviously don't. Some have got long-term investments in the fixed income markets that would benefit, and some would feel pain as a result. So this circular process that we have is something we constantly do, and it ensures that we can move and adjust the portfolio based on current realities in the market, and then add to that all the different new ideas that we can consider and compare it to the current positions in the portfolio.
Makes a lot of sense indeed. Maybe to look at your security selection and understand it a little bit better, maybe we can use a specific example. Something that I noted in your top 10 holdings, you've got a healthy exposure to Capitec. But if I lend my ears out to some of the analysts in the market, they reckon Capitec is expensive compared to something like a Nedbank. Maybe just explain why you would still have a big exposure to something like a Capitec.
Yeah, I thought it might be interesting just to simplify your total return from investments over time. And it's basically built out of three components. The one is the cash that you receive in your pocket. And that can be represented by free cash flow, or the dividend yield, or the gross yield to maturity, or whichever instrument you look at. But there's cash that you get now. And then some instruments like companies and property and certain properties don't pay out the full yield. They retain some of that, which means they've got the ability to grow, to allocate that capital to new ideas, or to grow the business that they have. And then the third component of all of this is the valuation. And if you, over time, if you look at different timeframes, in the short run, it's all about valuation. I mean, if the PE goes from 20 to 10, you lose half your money, as simple as that. But in the longer term, and the longer you remain invested with the business, the more important, firstly, your cash flow, your dividends become, and then long term, the growth potential that you get out of this business, whether it's your organic growth or expansionary growth or acquisitive growth even. So if we consider something like Capitec, yes, it is expensive on a current multiple basis. But what is the growth potential and the opportunity set out there? If you look at Capitec, at just about every single point in time since 2001, it looked expensive. And if you compare that then to the ultimate investment return that you generated and received as a long-term shareholder, that valuation did not matter. It was probably cheap. It was too low. So for something like Capitec at the moment, they have succeeded in building a large market position in the unsecured lending space to retail clients. But that's only one component of the business these days. They've got credit cards where they've got a small market share. They're a deposit-taking entity, and there they've got a small market share. They've entered into the mobile business now, where they've got a small market share in pay-as-you-go and data. There's insurance that's been added to the business. Funeral is selling very well, and the growth potential in life insurance as a whole is enormous. And then you add to that the fact that they've recently purchased a business bank in Mercantile Bank that's now becoming Capitec Business. But in every step of that process, there's a clear strategy that they followed, and that was look at where profit margins are wide, build a better product, price it cheaper, and make profit and take that market. That's what they did with the lending. That's what they're doing with banking. That's what they're doing in every step of the process. So we've got high conviction in the management team and their ability to deploy additional capital into this protected moat business of theirs and to grow it into diverse business lines over time. So we think down the line, the growth can continue. It earns 25% returns on equity, which is very attractive to reinvest in. And it pays a little bit of dividend at the moment, but that's not the attractive part. The attractive part is what the total profit pool is that Capitec can still pursue. And we've got high conviction in this business to do that in the long run. It doesn't mean that we don't look at cheaper businesses. I mean, something like Nedbank screens a lot cheaper, and it is also included in our portfolio. But we're quite comfortable holding a highly rated at the moment Capitec and out of favor Nedbank in the same portfolio.
Thank you for that. Goes to show that valuations on just a PE multiple can be a bit of a blunt tool, far more to it. Even I get excited now listening to you about Capitec. Let's talk about your SA equity allocation. SA equities is cheap. Doesn't matter which matrix you measure that on, but there's substantial deterioration in SA's fiscal health, and cost of capital is most definitely very high at the moment. And we're likely to hear a lot more about the troubles and the headwinds facing South Africa in the medium-term budget today. But I don't want to dwell on that. I want to look at your SA equity allocation in the fund, plus minus 40%, if I have it right. I stand to be corrected. Yeah, and you spoke earlier of asset risk compensation. Do you think there's still a good place for SA equities and client portfolios, especially if you compare that to something relative to SA bonds offering attractive yields of about 12%? Where do you stand on SA equity given all these macro events and where we are?
Yeah, so I think the short answer is that yes, we do see value in SA equities, and that's why we're positioned like this. We do own government bonds in the flexible fund, and the reason for that is that they are offering very attractive yields, and it's a more certain or stable outcome. And so there's definitely a position for that in the portfolio when you're getting these kind of yields. I think our government bond exposure is about 10%-ish, I think.
Total fixed.
Yeah. In the flexible fund, but we also do think there are a lot of standout good opportunities on the domestic equity side. So to say SA equity is cheap, they are probably some reasons for that. They're companies that do perform very poorly against a very bad macro backdrop. And there are many companies that have structural issues that when we screen them on our hurdles, they're things that we think mean that they probably won't stand the test of time. But we have found many opportunities in companies that are great businesses and that, like a Capitec, for example, even a ShopRite, that against this backdrop have performed phenomenally well. And that's because they've got great management teams in place, they've got strong competitive advantages, and I think it's the kind of management teams that are able to stay positive when things look very negative. And someone that can stay positive when things are negative usually means they can find great opportunities that others might be missing. Another example in the portfolio like that is Afrimat. It's a management team that's able to buy these brilliant assets at bargain prices, usually because of foreigners wanting to exit the country, or because it's just so difficult to mine here. It's so difficult to get the approvals that you need to get. And because they've structured their business in a way that is always on the lookout for opportunities and works so well within the South African system, they're able to turn around these kind of cheap mines that they buy or quarries, and have produced really, really quite incredible results. One of the top performers over the long term on the JSE because of that. So having those kinds of opportunities available, and then also things like domestic property, which we haven't spoken about yet, where it's a sector that's completely out of favor. And the reason for that is that property is extremely cyclical. And we went through a cycle of boom years in property when there was a lot of building happening. In that time, property companies were writing up the asset values, borrowing against that. Everybody was saying, why aren't you in property? I mean, it was a time when people could have made a lot of money from it. And then the cycle turned, and going through this period now where you've had interest rates increasing, balance sheets coming under pressure, property values, there was oversupply in the market, which meant property values have come down significantly. And it's, I think people that were in at the top of the cycle are very sad right now. But what that means is at the moment, property is completely out of favor. And if you just look at the fundamentals, you're getting dividend yields of, I think on Growth Point now is the 13% dividend yield in Growth Point. That's more than a government that you're getting on a government bond. Plus, they're trading at significant discounts to their net asset value, on net asset values that have been significantly written down through the cycle. So you now have three potential levers to drive that return. Even if property takes a while to re-rate, you're in a situation where you're being paid to wait now because you're getting a great dividend. There's potential for the stocks to re-rate to NAV, and for that NAV to grow, and for the dividend to grow as well as earnings re-rate through the cycle. And so we think that because there are those kinds of opportunities available on the JSE, and we weigh those up against bonds. Like I said, there's a place for bonds, but if we're trying to maximize the odds of delivering those kind of inflation plus 6 returns over the long term, these domestic equity opportunities really do stand out.
And maybe just to add one point to that, it's worthwhile remembering that when things are as dire as it's being reported in the papers in South Africa, the odds of international competition or new startups or new competition entering your market is lower, which means that any business with a strong market position and the ability to still grow market share has got the ability to grow its income statement and value in the long run.
Very interesting, that last point, indeed. I mean, it's it's almost like, glass half full, half empty. So that's the half full part of that argument. Back on SA property, I would think that your selection on SA property is very specific and very selective. You don't buy the broader market. Your allocation on SA property roughly about 6%. Catherine, but you mentioned, rewriting in that sector, but don't you think we need some sort of catalyst in the SA market for properties to rewrite? And isn't it perhaps too early? I don't know.
Yeah, we might be too early. I think that's fair to say. We don't know. But what we do know is that you're getting paid to wait. And that's why it seems like a very asymmetrical opportunity.
Yeah, I think I think, Eugene, you're right that you might need a catalyst for re-rating to happen. But I don't think you necessarily need re-rating to happen for it to be a good investment. Mm-hmm. If you've got a starting yield in the order of 13%, then, I mean, that's a dire future outcome that's being priced in if a company like Growth Point is trading at below half of its accounting net asset value. And if anything, if that dire scenario that's implied by the share price plays out, you're still going to get your yield. If that scenario is wrong and anything normalizes, whether it's interest rates coming down or the economy is showing a bit of growth or vacancies reducing, or there's a number of things that can be even just a slightly bit better than what the current price is suggesting, and then you'll get very attractive returns from these kind of valuation, these kind of starting points.
And maybe just to add that one of the elements that we look at very closely is balance sheet, and that particularly applies to a property company, and that applies both for our local and offshore property allocations. I think we've looked at those balance sheets with a fine-tooth comb to make sure that they can withstand a scenario where you might have rates higher for longer. We want companies that are anti-fragile, and we can maybe talk about that just now. But something like Unibail has very long dated debt, very well structured, so they're not in a situation where we need things to turn quickly.
I want to pick up the pace a little bit, but let's just stay on property for now. Global property, or your global carve-out in the fund specifically. We all know that you can allocate 45% of global assets in this mandate. Your global carve-out, very different, I think, to a lot of similar funds that I've seen. You also have global property, chunky at about 8%. Why is such a big allocation?
Well, I mean, it's exactly the story that we've now told about the local property side, only more so. The valuations of the properties themselves have been written down more. It's trading at a higher discount to its accounting net asset value, and the yields available are higher. So we are definitely not suggesting that you buy a blanket property exposure across the world. We've found value in European and British property REITs, and we've got a big allocation to it because we think it's a good asymmetric long-term opportunity.
And leans to that diversification within the fund, very often calls that I don't necessarily want to make. So I'm glad to see that you include that in that screening process that you explained earlier as well. Let's speak about your global equity carve-out, or global equity specifically, sitting at roughly about 33%. I don't see any exposure to, let's call them the Magnificent Seven, like the rest of the market. Is that because you see better opportunities elsewhere? Is it a price issue? And what is that pond that you fish in when you look at global equity?
Yeah, so maybe to say we do own one of the Magnificent Seven, which is Microsoft. It's just a smaller position in our funds. It doesn't show up in the top 10 offshore. And to be honest, we're always questioning that and wondering whether we shouldn't own more, because when they print results like they did recently, you realize this is a phenomenal business. What we like about Microsoft is just that, I mean, their competitive advantage and the diversification of their revenue streams with really still a very strong trajectory for growth. And when we look at the others, we certainly have had lots of moments of FOMO where we thought we should have owned them. But
yes.
Our way of thinking about technology investing in general is that it's often very hard to predict who the winner will be at the end point of someone who's consumer facing. So who's going to be the next company that's going to design the next killer product, the next killer app. Those things change very quickly. You can see, it's a very dynamic and fast-paced market. But there's one thing that enables all of those companies to exist, and that's semiconductors. So semiconductors are the chips that are used to power everything from your laptop to your smartphone, your washing machine and microwave, your car, and the servers that store information that we use on our computers and that enable something like this Zoom call to be happening. And so basically, if it weren't for semiconductors being produced at the very leading edge of technology, it wouldn't be possible for any of those companies in the Magnificent Seven to be operational. So we like that picks and shovels space of technology, because you don't have to be betting on the end point of innovation. You're investing in the guys that enable that all to happen. And within that space, it's a market that's consolidated significantly over time. So you're in a position now where in the different points of semiconductor manufacturing, there's a handful of companies, in each case, sometimes even only one company that can actually produce either the chips themselves or the equipment that's used to make these chips at the leading edge. And just for some context, the leading edge of chip manufacturing at the moment is that TSMC makes is 3 nanometer chips. They're literally producing things that are the fraction of the width of a human hair. So they're bending physics beyond anything that you could ever possibly imagine. It's absolutely phenomenal. And so, yeah, that's the space that we've chosen to play in, because we think it exposes you to those same growth vectors of technology, but without having to make narrow technology bets.
Yeah.
Very quickly, I want to speak about this conundrum in the market at the moment. If you look at US bond yields, it speaks to a high level, or acknowledging high levels of danger in the market, red flags popping up all over. But if you look at US equity specifically, it seems to ignore those danger indications, and it just keeps on going. If I can maybe compare that to the recent past, in a similar scenario where rates hiked and paused on a high level, if you look at the period 1994 to 1999, yes, rate hikes not that extreme, but similar scenario, went up, Fed paused, kept it high for a while. In that scenario, markets just kept going. But this time, given the circumstances, we're not really coming from a place of strength. Do you think that the markets can continue going, or do we need to read more into where the Fed's going and where bond yields are going, that we could still be in for a hard landing?
Well, I mean, if we had the answer to that question, we'd make a lot of money.
Exactly.
Unfortunately, we don't, and we won't know. But as I said, and with the bit of macro that I alluded to earlier, yes, it is true that the US bond yields have increased a lot. But if you take it in a long-term view, that increase just kind of normalizes us to a few years ago. It's not like we are at extreme levels that we saw with the inflation shock in the 70s and early 80s. So maybe this is a new higher level. I don't know. It's possible that this could be a level that we might be on for longer. And then what you want is to ensure that the investments that you've invested in have got the ability to withstand that high interest rates. And for that reason, we consider the balance sheets of the companies that we invest in. But you also want to have the combination of a management team and an opportunity set to adjust and rejig the business if it's required from a big wholesale change like this might be. And we think we have it. And I think if you consider something like the digitization of the world, I would suggest that that's going to happen irrespective of what interest rates are. Every time that labor is substituted for automation, it leads to higher margins for companies. So if they're getting pressure on the interest line, you look for other ways of reducing costs, and automation would be, it's unfortunate for the labor force, but that's a logical next step, irrespective of what the economic backdrop is.
We're a bit pushed for time, and I can keep you busy here because there's a lot of questions I have, because your investment process I find fascinating and how it comes together. But I always tell clients, proof is in the pudding. This fund launched at a very peculiar time, right before the news on COVID broke. How did you manage that process, and did it come through in terms of performance?
So how did we manage it?
I've been working here for 2 months. I think there were 3 of us that started in January 2020 because we were launching these funds. So we started as opportunity analysts. So I think we had 2 months in the office. I think I went to one in-person presentation of a company, and then COVID hit and we were all working from home. But I think from a people perspective, we managed it phenomenally well. I think having teams already available we were already working quite digitally, and there were some incredible things that happened at Granate to kind of keep the gears going. We had a colleague doing workout sessions with us every day to keep us motivated. And what happened was that it actually created a really phenomenal opportunity. We were producing research like there was no tomorrow, because they were basically everything in the world was on sale.
Yeah, and if you look at this table that we've shared now, that shows our return since inception. And as you rightly said, we were foolish enough to start our fund 6 weeks before the bottom of COVID, and just before COVID was announced. So in a perfect world, this would look a lot better if we had our timing right. But the fund has managed to, for close to a 4-year, 3.5-year period now, to outperform its benchmark of inflation +6. It did deliver close to inflation +9 over that period. And we're quite proud of this track record, because it shows that the philosophy and the process works through pandemics and wars breaking out, and a whole range of difficult economic environments that we've seen, both locally and on a global basis.
It did indeed. And Catherine, thank you so much for your time this morning. Unfortunately, it's the end of our session. We would really like to see a lot more of your funds in the near future. I know we've had a lot of exposure to Paul and Bronwyn on your fixed income side, your flexible fund, your balanced fund, truly something to keep in mind when you construct client portfolios. And if you don't want to get actively involved in the asset allocation, give it to the experts. They obviously prove that they can do it very well. To our audience out there, quick reminder, next week, Wednesday, 8 November, we've got 361 Asset Management. But for today, Catherine, thank you so much. I know your colleagues are also online, Simone and Alex. If you want to know anything more about the Granate funds, please get hold of the BCI team or Simone or Alex, and we can steer you in the right direction. Guys, thank you so much for your time. I'll chat to you again in your future. To our audience, keep warm and keep safe.
Thank you very much, Adrian. Thanks, everyone. Bye.